What if I told you there's a powerful investment tool that most beginner investors completely overlook, yet it can dramatically reshape your portfolio's risk and potential returns? You might have heard of stocks, bonds, and mutual funds, but the world of futures remains a mystery to many. Today, we're uncovering how futures contracts could be the game changer you never knew your portfolio needed. Stick around if you want to learn how savvy investors use futures to hedge risks, speculate on price movements, and even unlock greater diversification, all while most people miss out on these benefits entirely. Let's start by understanding what futures are and why they matter so much in investing. At its core, a futures contract is an agreement to buy or sell an asset at a predetermined price on a specific future date. These assets can range from commodities like oil, gold, and wheat to financial instruments such as stock indices and treasury bonds. Unlike simply buying shares in a company or holding bonds, futures are derivatives. Their value depends on the underlying asset's price, but they allow much more flexibility and strategic maneuvering. Imagine you own a farm and worry wheat prices might plummet by harvest time. By entering a futures contract to sell wheat at a fixed price now, you protect yourself from that risk. This is known as hedging, and it's one of the primary reasons futures markets exist. But for investors, futures represent more than just a risk management tool. They provide access to markets and sectors that are otherwise hard to invest in, especially commodities, which behave differently than traditional stocks and bonds. Because these assets often move independently of equity markets, adding futures contracts to your portfolio can improve diversification and reduce overall volatility. Now you might be asking, is trading futures only for big hedge funds or professional traders? Not at all. Thanks to modern brokerages and more accessible platforms, individual investors can participate in futures markets with smaller amounts of capital, gaining exposure previously reserved for institutions. However, that accessibility brings its own challenges, especially given the leverage involved, meaning you can control a large amount of the underlying asset with a relatively small deposit, amplifying both gains and losses. Let's explore the first major way futures impact your portfolio: hedging against price risks. Many investors are familiar with market ups and downs, but what they often overlook is how futures can literally protect your investments from unpredictable swings. For example, suppose you hold a significant amount of oil-related stocks, and you worry about geopolitical tensions disrupting supply and causing price volatility. You could short oil futures contracts to offset potential losses in your equity holdings. This strategy acts like an insurance policy. While it requires careful monitoring and understanding of contract expirations and margin requirements, hedging with futures can mitigate severe downturns, smoothing your portfolio's overall performance. To illustrate, consider the 2022 spike in oil prices amid geopolitical conflicts. Investors with only oil stocks faced sharp volatility, but those who included short oil futures helped balance their exposure, avoiding some of the worst drawdowns. According to a report by financial analysts at Barclays, portfolios using commodity futures for hedging saw around 20% less volatility over the year compared to traditional stock-bond portfolios. This risk reduction is especially crucial for investors nearing retirement or those looking for stability during uncertain economic times. Beyond hedging, futures also offer a speculative opportunity for investors who anticipate market moves. This might sound risky, but with the right approach, speculating with futures can boost returns without necessarily increasing your overall portfolio risk, if done prudently. Speculation involves taking a directional bet on an asset's price. For example, if you believe gold prices will rise due to inflation concerns, buying gold futures can provide substantial profits without having to physically own and store gold bars. But it's important to understand the mechanics. Futures contracts require margin deposits, which are fractions of the contract's total value, enabling significant leverage. This amplifies gains but also losses if the market moves against you.